Good morning, everyone. Whether you're joining from a credit union office, a fintech workspace, your home office, or a very ambitious coffee shop Wi-Fi, welcome. I'm really glad you're here. Let me start by setting expectation early. This is not a sales pitch. It's not a debate, and it's definitely not a Shark Tank episode. No buzzers, no surprise equity grab, and no one is getting voted off this island. Credit union to become fintech. It's not about fintechs becoming financial credit union. What today is about is something much more practical and honestly long overdue. It's about why two groups who actually want the same outcome keep circling each other, talking past each other, and occasionally wondering why they just don't get it. And it's about how bank as a service gives us a structure where both sides can work together safely and realistically, and how without anyone abandoning who they are. So think less of panel discussion and more like couples therapy, but for regulated financial institutions and fintechs. And yes, this is one of those rare relationships where both sides really are right. On one side, we have people who ship in codes and sprints. On the other, we have people who think in policy, exams, and decades. And somehow, they're all supposed to work together. If you ever thought this should work, so why doesn't it? This is the talk for you. Let's get something important out of the way early. This is not a rivalry. Credit union and fintech are not enemies, they're not opposites, and it's not a winner-takes-all narrative. In fact, you agree on more than you may realize. Both serve people, not products. Both aim to improve financial lives. Both care deeply about access, inclusion, and long-term well-being. And both, if we are being honest, struggle when they try to do it alone. Fintechs struggle with regulation, trust, and long-term relationship. Credit unions struggle with legacy system, challenging member expectation, and the pace of the digital behavior. So if the mission is shared, why does it feel so hard? Because the difference isn't mission, it's method. Fintech are built for speed, for credit union are built for stability. Builder ships in sprints, cooperative planning decades. One side asks, can we deploy this by Friday? The other asks, will this still protect members 10 years from now? Both questions are valid, and this part matters. Both approaches are right. They are just optimized for different risks. Same destination, very different GPS voices. One says rerouting, the other says, please submit a policy update with supporting research attachments. I want to reframe fintech partnership in a way that feels similar, especially to credit union leaders. Think of fintech partners as digital branch operator. Historically, when credit union wanted to grow, they opened branches. Branches meant visibility, access, community presence, member growth. Fintech are the modern evolution of that model, just without the building. Fintech handle the front of the house, attracting member, onboarding them, designing the digital experience, and driving daily engagement. Credit union, with banking as a service support, handle the back of the house, the charter, the compliance, risk management, and protecting member trust. Think of fintech as a friendly staff at the front desk, engaging member, testing new ideas, modernizing the experience, while the credit union remain responsible for keeping the vault in balance and the lights on. And there's the key distinction that really matters. Vendors sell tools. Fintech bring members. That's not all the difference. That's not a small difference. That's an entirely different growth strategy. It isn't outsourcing. This is branch expansion, modernized. Same responsibility, modern footprint, no real estate, no terminal line, and no geographic limits. And here is the bonus. Regulators are already comfortable with branches. After all, they've seen those before. The real shift here is realizing that growth no longer requires more building. It requires better distribution of trust. Let's talk superpowers, because this only works when both sides bring theirs. Fintechs are very good at what they do. They build technology that scales. They leverage venture capital to experiment quickly. They design experiences around how people actually behave and not how policy wish they would behave. They use APIs and embedded experiences to meet people where they are. They test, iterate, and improve at speed. In short, fintech remove friction. Credit union brings something fintechs can manufacture: trust. Not algorithmic trust, but human trust. That trust show up in member ownership, in nonprofit structure, in regulatory discipline, in community accountability, and in long-term relationship that last decades, not product cycles. Credit unions don't just move money, they protect people. Fintech move fast and remove friction. Credit union move carefully and protect lives. Progress slow when either side assume its strength is sufficient on its own. Real impact only happens when these strengths are treated as complementary, not competitive. Honestly, we need both. Together, well, that's when it gets interesting. At the end of the day, this is still about people helping people. Fintechs expand access through technology. Credit union deliver deepen care through people. Different tools, same heart. And when those align, growth stops being a trade-off between scale and care and becomes a multiplier. You don't get compromise, you get leverage. So why those groups keep missing each other? Fintechs speak speed, credit unions speak risk. Builders build shipping sprints and cooperative planning decades. One side says, move fast. The other hears, that sounds dangerous. One side says, let's slow down. The other hears, that sounds like we're falling behind. And here's the kicker. Both are right, and both get frustrated, usually for good reason. They miss each other because they are really good at different things, and they are looking in different direction. One focuses on moment, the other focuses on the lifetime. Fintech asks, does this feel good right now? Credit union asks, will this still protect member 10 years from now? That tension isn't conflict, it's care, expressed differently. What often sounds disagreement, it is really two different definitions of responsibility speaking at the same time. The real problem isn't technology, it's translation, it's trust, and it's structure. Most partnerships don't get stagnant because the idea is bad. They get stuck because expectations aren't aligned, risk isn't fully understood, and no one truly owns execution. The idea is not bad. In fact, it's usually a great idea. We know adult supervision. This is where banking as a service come in. BaaS is the connective tissue. Fintechs stay focused on member experience. Credit union provide the charter, compliance, and trust. BaaS provide the structure that align innovation with stability. This is regular rail meeting modern interface. Innovation without abandoning responsibility. BaaS doesn't remove responsibility from either side. It makes responsibility explicit. When people hear banking as a service, they often think infrastructure, APIs, vendors, plumbing. And yes, there is technology involved, but BaaS is not just pipes and permission. At its core, BaaS is a partner model. It defines who does what, who owns risk, who owns relationship, and how innovation happens without breaking trust. And this is important because the fastest way to kill a good fintech idea is to drop it into a financial institution without structure, clarity, or accountability. BaaS create rails, not to slow an innovation down, but to keep it from going off a cliff. It aligns incentive. Fintechs succeed when members engage. Credit unions succeed when members are protected. BaaS makes those goals complementary, not competitive. This is how growth stops being attractive and start being cooperative. And it modernizes the way people helping people and how it looks in a digital world. Because people, they don't just walk in branches anymore. They show up in apps, in platforms, in moments embedded inside their daily life. BaaS allows credit union to show up there without abandoning their character, their mission, and their regulatory responsibility, not to mention the charter. So BaaS doesn't replace the credit union. It extends it. It doesn't remove responsibility. It organizes it. And it doesn't dilute trust. It scales it. Carefully, intentionally, and with guardrails. That's what BaaS really enables. Not faster banking, better banking, delivered differently. And it modernizes what people helping people looks like in a digital world. For fintechs, let's talk about why fintechs actually make strong partners for credit union. When the relationship is structured correctly, fintechs are built to reach digitally native members. They meet people where they are, in apps, platform, and a better experience without requiring the credit union to expand geographically or operationally. Fintechs are designed around real-world financial behavior. They test, learn, and iterate quickly, which allows new product and experiences to be refined before they ever touch the credit union core system. That means innovation can happen without balance sheet risks. New ideas can be explored without disrupting the core, the branch network, or existing member relationship. Strong fintech partner function as growth partner, resulting in expanded opportunities and stronger member long-term relationship. Depending on the partnership, such opportunities translate into more member deposit and on more loans. Growth that aligns with mission and flows back to member owners. Fund can be reinvested into community outreach, financial education, staff, and technology. Fintechs focus on experience and engagement, while credit unions retain authority, governance, and member protection. Fintechs don't replace the credit union, they extend it safely, deliberately, and in alignment with the mission. When fintechs are treated as growth partner rather than vendors, innovation stops being a risk and start becoming leverage. Modern growth that strengthens, not the credit union mission. When fintechs look for long-term stable partner, credit unions stand out, and not by accident. Credit unions operate under NCUA oversight. That means a single focused regulatory framework, fewer conflict expectation, and clearer supervisory relationship for partnership programs. Credit unions are the original financial inclusion model. They were built to serve community, expand access, and put people first, long before inclusion became a product category. Credit unions are built for service, not for profits. They are not external shareholder pushing for short-term extraction. Success is measured in member outcome, not quarterly return. In well-structured fintech partnership, sponsorship fees flow back to the member owners. What is often a cost center elsewhere becomes a value driver that strengthens the cooperative and community it serves. And in many ways, credit union were fintech before fintech had a name. They innovated around access, trust, and share ownership, just with different tools. What does modern financial look like? Technology that empowers innovation without requiring fintech to become financial institution. This is where CUelevate, which is my company, fits into the picture. We serve as their translator because API and examiner are very different dialects. We help credit union and fintech understand each other's language, expectation, and constraint, so alignment is established early and risk is addressed intentionally by the party who owns it. We act as the de-risker advisor, supporting partnership structure that respect regulatory boundaries, clarify roles and accountability, and reinforce that the credit union retains full governance authority and responsibility for member protection. And we operate as execution bridge, not by owning the outcome, but by helping both sides define them clearly. Because good ideas don't fail from lack of vision, they fail when ownership of detail is unclear. Practically, that means we help credit union elevate readiness, risk exposure, and partnership structure, so they are informed and deliberate. We also help fintechs understand cooperative finance, not only the regulatory framework, but the value and operating realities that makes these partnerships sustainable over time. Most importantly, we support credit union and fintechs as they lead their own launches, helping ensure initiative and structure in a ways that regulatory can evaluate, board can govern, and members ultimately benefit from. The gap between a good idea and a safe launch is almost never technology, it's translation and ownership. The future of finance is cooperative. Embedded finance is accelerating. It shows up everywhere. People already live, work, and transact. And at the same time, trust has become the scarce asset. Technology is abundant, capital is abundant, but trust is not. In this environment, ecosystem will outperform standalone institution. No single organization can move fast enough, manage enough risk, or serve enough needs on its own. This is where banking as a service becomes the bridge. It connects modern financial experiences with regulated, trusted financial institutions. And the mission is the glue. the shared commitment to helping people, not extracting from them. Fintech don't need to replace credit union, and credit union don't need to replace fintechs. Together, through BaaS banking as a service, they can help people better than they ever could alone. In a world where technology is abundant, trust becomes the competitive advantage, and trust is built together. I'll close with this. What we're really talking about today isn't disruption, it's alignment. Credit unions have spent decades earning trust, protecting members, and putting people first. Fintech bring new way to reach people, serve them digitally, and meet them where they are. Banking as a service doesn't ask either side to give that up. It creates structure where both strengths can work together, safely, responsibly, and in serving of the same mission. When partnerships are built with clarity, accountability, and trust, everybody benefits, especially the people we are here to serve. The institution that lead the next decades won't be the loudest or the fastest. They will be the one that learned how to align. Thank you for the work you do, the openness to new models, and for taking the time to be part of this conversation. If you'd like to continue it, I'll be happy to connect.
Thank you, Katia. This was wonderful. For the context of for our association, yeah, Katia was somebody I was introduced to by one of the other members of the association, John. And it was great because Katia at the time was credit union CEO. And so we got to meet and talk about early on how we were thinking about starting our own credit union at Cassandra. And she's been an instrumental mentor as we've gone through this process. One story I kind of open up with, Katia, is the first time we introduced you to a fintech to discuss doing a potential BaaS partnership. This was like way before all the knowledge you have now. But can you maybe take us back to what it was when you first heard about banking as a service and you actually met a fintech, how it would have affected the economics of your credit union at the time?
Yeah, for a while, it was hard to understand the difference between banking as a service and I was using the terms as interchangeably. So now I laugh because I just give a presentation about the difference. But I guess sometimes you have to go through it yourself so that you know the struggles and what other people may be thinking when they're not familiar with it. But so I met, and I can say who I met with, Lorenzo, or you don't want me to? Okay.
Yes, absolutely. Yeah, we can talk about Neil. Neil is a member.
Yes, I met with Honor. And he was phenomenal. You could tell there's just nothing but pure passion, love, and of course, mega intelligence and smarts and all that. But the passion is what I latch on to because myself, I'm a very passionate person. And so all the other things matter too. But if there's no passion, you're not going to get me. And it was funny because he was talking about bringing 10,000 members, and our credit union, the credit union that I was serving as a CEO at the time, only had 4,500 members. So that meant literally 200% growth. So at first, panic set in, saying, okay, my staff doesn't have capacity. There's no way we're going to die. NCUA is going to kill us because it's too much growth too fast. And I was, okay, what a dummy. Everybody's struggling.
It's a good problem to have, right?
Yes,
it's the opposite.
What a dummy. I said, when everybody else is struggling to attract members and to grow their loans and everything else, I was there freaking out about doing it too fast. And so as he kept talking, Neil kept talking, I finally found my voice of reason. And there was one episode that shocked everybody. Neil was talking about how banks have requested extremely unreasonable deposits just to offset potential charge-off and just the portfolio as a whole. And I said, we don't need that much because we know how to underwrite to those that don't have perfect credit. So we know what the expected loss is based on our own current portfolio. And so we can just ask you to put in maybe just a little bit more for a cushion. And then the rest, we can see if our insurance provider can cover the fraud risk, because that's the fraud risk is always the unknown there. But there's insurance for that. And so I say, maybe we can just say, okay, our portfolio will grow tenfold in the next year. What is the new premium is going to be? And just tell the fintech, pay me the difference. We don't want to make money off of that. We just want to make sure that everybody's safe and nobody wastes money. So that was one of the interesting part of that. So very differently. The credit union in general thinks so very differently than bank. Bank are looking for the no, for the, if I'm not going to make mega bucks for my shareholder, that's not worth my time. And credit union, are we changing lives with this? Because if the answer is no, forget it, we don't want it. But if the answer is yes, as long as we don't lose our shirts on it, We're more than happy to do it because the true payoff for credit union that still has the true credit union mindset is to help people, is not to make money. That is never
Well,
for
it also makes
successful.
money. I wouldn't want a credit union that is money obsessed to think that there's not a ton of money in banking as a service. It also happens to make a ton of money, but yes, I agree with you.
But
It's the mission component, right? Because this was
yeah,
not going to be 10,000 random people. It was 10,000 veterans who are underbanked in some other respect. And so it's not just random
and
people.
and that's the thing, those money, because you will find some credit union people that see making money as a bad thing if it's more than a small percentage. And but that's where differently is every extra penny I make for me is a major opportunity to give it back to the community that we serve. So what that looks like is, first of all, you can always do lower fees on lower interest on loan, no fees or lower fees or higher return on deposit. But you can go way beyond that and actually be in the community and create opportunities such as what Scott was talking about earlier,
Exactly.
a whole new
Exactly.
product,
Exactly.
a whole new giving chance to people. Because if this is free money that you weren't expecting, right? Then you can play with it and see where it takes you. And that's when amazing things happen. That's what the credit union industry and the players that still have the cooperative spirit and passion, that's where this industry is the best in the world. It's just hard to let people know how fantastic credit union are because most of us are not good self-promoters. We're the quiet and behind the scene that do amazing things and just don't tell.
Yeah, no, absolutely. In many ways, Scott's presentation highlighted how credit unions are innovating. They're probably the most innovative financial institution compared to a regular bank, but they're not innovating on the financial engineering side. They're not innovating on the technology side. They're innovating on their relationship. It's why the most amazing, innovative programs, the ones Scott described, it's really not technically or financially complex, but it's very complex from a community, a relationship perspective. And that's where they become very complementary to fintechs, right? Who bring the technological and financial engineering innovation. And so if you combine that with innovating on the relationship, you can come up with some really amazing things. And hopefully at today's forum, we saw an example of that, right? With the life cycle investing proposal, right? And
Yes.
how even the creator of it thought, it should be run by a credit union because that way the loans that people invest in their index funds with are loans to the members, so the money stays within the community. And that's part of our mission here at Cassandra, is to really show to the fintech world the power of credit unions and what they represent with this co-ownership membership model. Because otherwise, if you ask the average fintech that's trying to find a bank partner, if you talk to a credit union, they say no. Most of the time it's because they haven't thought about it. And if they have thought about it, they think credit unions are low tech. They probably are risk averse. They don't want to, they're probably going to be less likely to do new things than a for profit bank. And that could not be further from the truth.
Yep. Absolutely.
Yeah. What has been the most surprising aspect of learning about these banking as a service partnerships for you? Yeah. What has surprised you the most?
I love the fact that at its core, banking as a service take away one of the biggest probably fear that the smaller credit union may experience, which is risk. So in the example earlier, if you're talking about tripling my current membership, that comes with a lot of risk. And then that means I have to hire more staff or delegate. And so that means we may not have the time to fully train them because a lot of people in the small community world have been in it for a very long time. So they're veterans at what they do. And bringing in more people, they may not understand how to see everything. But BaaS puts the guardrails. And so that to me is from a CEO perspective, former CEO perspective, that means a lot because it's not just me not knowing what fintechs are, how they work, what the space look like, trying to figure out how will NCUA look at this, which is the regulator, how will they
Well,
misconstrue this
in
relationship?
fact, Kyle Lipman, the
Yeah,
chairman of
yeah.
the NCUA, actively is calling for credit unions to do more fintech partnerships, which is the opposite of what the FDIC and the OCC have said
Yeah.
to for-profit banks. For our audience, one thing maybe I want to underscore about this is part of, if there was a single anecdote that I want people to really latch onto, to really understand the power of credit unions from a regulatory perspective, is the fact that a cannabis CUSO So basically a corporation that helps credit unions do cannabis banking, went public through a SPAC in 2023. So while most for-profit banks are stuck on, oh, we can't do cannabis banking because it's too legally complex and the regulators would never let us, right? Credit unions have been laughing all the way to the bank.
Literally.
And that's the way I frame it to everybody. Is if the NCUA allows credit unions to do cannabis banking, certainly they're never going to encourage anybody to do anything nearly as risky as that. And and it's what makes credit unions such a great partner for a banking as a service relationship.
Yes. Credit union are more out of the box thinker per se, because you eliminate the money making aspect of things and you're looking more at people. And in my experience in 25 years in the industry, when you care for people and you resolve their issue or fulfill their desires, then money will follow. There's no question. So for me, banks see the world in a very opposite way than what I used to see the world. Is when I look at anything, I look at who is going to benefit, but not financially. At the core, as a human being, am I affecting you in a positive way? As a matter of fact, it's funny that you say that, because in my tombstone, I don't care about my name. I don't care about the dates. I don't care about anything. I just wish and would love if somebody would put, she made a difference. And that's it. That's all I care. Because I try to touch people with every iteration, with every time I talk to anybody. I hope that I can leave even the smallest impression that the world is a magnificent place to be and that we can all participate to make it better.
Absolutely. I don't think it's an exaggeration to say that given your banking as a service consulting offering with CUelevate, you will go down in history as one of the leaders of banking as a service in the credit union industry. Because I guess you're not a pioneer. It's not, there'll be a couple of other people dipping their toes into it, but certainly you're becoming a thought leader in the space because you said you're the translator between these two different worlds. And so that alone will go a long way in making a huge difference because you're going to be impacting two different industries at the same time. And they're some of the most valuable industries that affect so many people because everybody needs access to financial services, right?
Everybody deserves access to financial services.
Even the incarcerated. That's why I'm glad we had Scott presenting.
Yes.
There's no JP Morgan Chase is not banking incarcerated people. Only a credit union wouldn't even think of that. And I really want to emphasize for our community how this is the way our mission really matters, is because by building financial services for the least advantaged among us, for the most marginalized people, we end up building a better financial system for everybody. You don't build a better financial system by optimizing for the 1%. You build the better financial system by optimizing for the bottom 1%.
You raise the medium and the bar.